our President, Bill Dunlop, who would like to say a few words this afternoon. So Bill, over to you.
Hi, good afternoon, ladies and gentlemen. Thanks for joining us today. I'm just going to go through a few headlines of what AICDP have on their minds as we move into this new and quite challenging year. There's probably three headline levels, and I apologise because you can't see me. Well, maybe I should actually, you may be quite grateful that you can't see me. But anyway, the first thing is that this aspect of that we've talked about before about getting out of the bunkers. Post-COVID, I think it's absolutely essential that we reshape people's attitude in terms of within the credit collection profession to get in front of people again. And we really need to do that. And we really need to do it big time. So from that perspective, we've done some work already. Later last year, I attended one of Declan's event in Ireland. And it was an interesting event because most of the people there, and it was a very well attended event, probably significantly increased in the year before. When we actually analysed the people who were there, what we found was that in the main, the people who were there were people who were mainly SMEs. And what was the significance of that? Because Ireland has a large community of large shared service centres with whom we deal with quite a lot. But in this particular case, it was SMEs who were attended. And the governing factor in SMEs is SMEs own their own decisions in the main. And they decided to be there. The large corporates did not decide to be there. And at first thought, you may be seduced to thinking that the large corporates were looking after their employees. They were not. They were protecting themselves from corporate liability from the spread of COVID, which is hugely disappointing. We really need, as a profession, as individual economies, to change that, because there are certain functions within businesses that just do not operate without face-to-face activity. So we need to get particularly credit management and sales back in front of the customers. Now, in that regard, there are no easy answers to how we do this. But one thing I would like you to think about, how we interact internally need not be reflected in how we interact with our customers. Now, when I say that, what I particularly mean is that if our companies choose to stay in the bunkers, it doesn't mean that sales, credit management can't get out there face-to-face with organisations. And I want to get you to think about something here. Every credit professional should strive to encourage their employers and their clients to return to F2F engagement. That's face-to-face engagement, because that's the way it works. It's worked for that, like that for many, many years. If we don't do that, we'll contract into a position where we are in bunkers and we're in bunkers forever. That's not good for the future. These are headlines. I'll be writing some more stuff about this, and these slides will be available. But I would like every credit professional to think about this and to see what they can do. The second thing I want to talk about is adapt to the new models. What I think is happening, what I anticipate is happening, and that's underlined by various conversations I've had, that most appear to be going to 2/3 3/2 home split. Okay. Now, actually, to get there is challenging, but hey, that's not difficult for professionals. We do it all the time. We address problems with organization, with product, etc. So we can do it. And the problem is the advantage and the problem is there are definite financial benefits from these changes. Our companies are going to be looking at, well, we can have a smaller headquarters. We can have a smaller footprint. We can have people working at home. Sure, we have to maybe compensate the people who are working from home and give them finance for home offices, etc. But is that the appropriate thing? So we can, whatever the outcome of that, we can do it. Making the model work is a completely different matter. And that's where it comes to our professionalism. Because there are certain questions. I don't have all the answers, but how do we maintain and how do we improve results? If anyone out there thinks we will be judged on getting the model changed, they're wrong. What we will be judged on is getting the model changed, which we can do, as we've already said, and maintaining and improving performance, because that's what it's all about. But another couple of things that we have to think about is that, and then it becomes less tangible in terms of the results. How do we identify talent and develop the organization? How do we create and maintain teams? Because the teams that we have are moving to different environments. They will continue to evolve, and we need to be getting all of this right. And that's a much more complex question. Last question I want to leave with you for consideration. And it's an almost hypothetical question. Is a 100-seat shared service centre based in one country now the right model? And what I mean by that is that if, pick a country, Poland, pick a country, Ireland, if you've got a 100-seat shared service centre there, and it's been evolved to you employ locals with language skills, etc., and you build it up. In the new environment where you perhaps have a small hub and people remote, would it now be more appropriate to employ people Spanish for Spain, Irish for Ireland, French for France, etc.? So we need to be thinking about these things. And I don't see any particular evidence of that happening. So there's a lot for us to be thinking about. The last point that I want to raise today is the geopolitical risk. I've been in this business a long time, and I have to be honest, the geopolitical risk hasn't been a major issue. But not since the early 1960s have we faced such a war. I vaguely remember in school the Cuban Missile Crisis. People didn't believe they were going to wake up in the morning. It was that bad. And since then, we've had an evolution of leaders and society that don't remember that. They don't remember the consequences of World War II or World War I. But we are in a bad place just now. The Ukraine could be days away. I watched the news before I came on here today, and I was quite horrified by the escalation. It's galvanized NATO. It's not just galvanized NATO. Countries like Sweden and Finland, who are essentially neutral, are getting to the place where they are deploying troops, getting concerned, worrying about the Baltic, etc. Taiwan could be similar and probably will be similar. In fact, I would rate Taiwan as a greater threat of war than the Ukraine. Now, in that regard, if you consider the economic risk of that, is that Taiwan, last time I looked, had about 2/3 of chip manufacture worldwide. That's quite a horrific thought. If you add to that the dependency on Western Europe gas supplies from the east, it's not a good situation. Excuse me. The whole of the Pacific Rim is falling into one camp or another. So you've got Japan, Australia, etc., etc. Everybody's arming, everybody's lining up against each other. Russia and its close allies, China, North Korea, Iran, are all arming fast and conducting joint military exercises. That's scary. It's totally scary. If you add to that, I recently read that India is also getting in the act, and probably Pakistan, because of historic differences, is going to fall in on the other side. Historically, such vast rearmament and unholy alliances, and it's perhaps completely unfair to say that, has not ended well. A personal observation of mine is that as a kind of student of recent history, I would say that today the world is in a place where prior to World War I and prior to World War II, there are more countries, more troops, and more weapons who are coming to readiness than in any of those conflicts. Now, I don't want to put a dampener on anyone's day, but there are serious implications of all of this for all of us. I intend to write some more stuff about this, and I'd be very happy to engage with people because it has a very personal effect on all of us, but it also has a professional effect on us. So, yeah. So I'm sorry to be such a bearer of glad tidings, but I will pass you on. Thank you.
Thank you very much, Bill. Thank you for that. I'm now going to pass you on. Could I just ask if you're not speaking, I could just ask you to pop yourselves on mute. We're just getting a bit of feedback at this end. That would be lovely. Thank you. I'm now going to pass you on to Marcus Cougar. So following on from a stint at the European Parliament in Brussels, Marcus joined Dun & Bradstreet's Country Insight team in the UK in 2010, where he covered political, economic and credit risk in Western European countries. After 3 years at DNB's chief economist, he resigned in September 2021 and returned home to Germany, where we spoke to him on Friday. He is now working as a freelance economist and also advising global connections firm Bakering on a regular basis. So Marcus, I'd like to welcome you, and you now have control of the screen if you would like to join.
Thank you, Claire, for the introduction. There's one role that we haven't mentioned yet, and that was my engagement with AICDP. Because, as you remember, in 2016, I became the economic advisor. I passed that on to one of my colleagues in 2019. I always enjoyed participating in the AICDP events. I was very much looking forward to a face-to-face event in London. Unfortunately, COVID is still there. I was still on mute, so I have to say the whole thing again.
No, you weren't. No.
I wasn't? Okay, perfect. Then excellent. I just moved the slides then. I brought an agenda with me that Clara can't seem to move the slides forward.
Yep, you should be able to now.
I pressed enter. Now it works. There's a delay. The agenda of my presentation today, which should take around 25 minutes to get through, looks as followed. We're 2 years into a pandemic, and you can't talk about the economy without covering COVID. So I'm showing you a few stats about where we are in terms of vaccinating people, what the caseload looks like. But then we will move on to topic number 2, which is an area I know much more about than a virus, and that is the economy. I will talk about how the economy did last year, and I will give you an outlook what economists expect is going to happen this year. And there are many downside risks. Bill has already mentioned politics, but there are many others, and we will cover that in chapter 3. Then there's a summary, and then there is time for Q&A. I know Claire has already invited you to do so, but please submit your questions and we will host a Q&A session at the end of this event. So when we look at the vaccination program, we have to say that there was some tremendous progress over the last 12 months, 14 months. We mustn't forget that it's only been basically a year that vaccines came on the market. And countries like the UAE, Portugal, Cuba, Chile, they've vaccinated around 90% of their population. The developed economies stand at around 70–80%. There's quite a background noise. If everyone could go on mute, please, that would be much appreciated. But as you can see, when you go down that list and you reach the developing economies, emerging markets, you see that this rate drops quite a bit. I've included Ethiopia and Nigeria here, where less than 10% of the population has been vaccinated. And that's causing all sorts of problems. On a global scale, there are still 40% of the population that hasn't received one dose. When we look at the cases, I'm waiting for the screen to move. Yes, when we look at the cases, we've seen some tremendous spikes in recent weeks. The Omicron wave hit. The good news is that in some countries, it's going down again. The UK is one of these countries, France as well, but there are still countries like my home country, Germany, some countries in Central Europe where the caseload is still rising. And that is creating some questions about lockdown measures. I can tell you here in Germany, things are much more restricted than they are in the UK. The good news is that we haven't really seen a spike in death rates and hospitalization. Yes, there has been an increase caused by COVID, by that immense increase in cases, but ultimately the death load wasn't that big. It was still below the first wave as well as the second wave, so that is leaving some room to be optimistic. I'm waiting for the slide to move. Oh, we moved too many now. Yes, let's have a look at the Stringency Index. That is something that the University of Oxford is creating. They're looking at all sorts of metrics, lockdown measures, school closures, workplace regulations. Do people have to wear masks? Can they go abroad? And they condense it into a single indicator, a Stringency Index. And you can see some diverging movements here. Some countries like the US, as well as the UK, they've lifted restrictions. And there are some countries like Germany, China, Italy, where restrictions are still fairly severe. We have to keep one thing in mind here, and that is that this index looks at the geography with the most strict rules in the country. So in other words, in Germany, we have 16 states. The rules are slightly different. So this displays the rules in the region where the rules are strict. It also looks at certain groups, and it looks at the most impacted groups. So in other words, this figure here gives you the regulations that apply to non-vaccinated people in a certain part of Germany, in a certain part of China, and a certain part of Italy. And the rules for these people are much stricter than they were in the first and the second wave. For example, in Germany, you can't even go on a bus or a train anymore without a test or without being vaccinated. That just as a bit of background information, don't look at this chart and think, oh, in Germany, the lockdown measures are as bad as they were a year ago. They are as bad as they were a year ago, but only for certain parts of the population. For the overall majority of people, it looks a bit better. That's all I want to say about COVID. As said, I'm not a virologist, but I think you can't talk about the economy without talking about that pandemic that is still having a huge economic impact. But let's talk a bit about GDP, gross domestic product, still the indicator that every economist uses. And there are some good news. The good news is that last year, the economy grew, global economy that is, grew by around 6%, which is very, very high. For next year, or not for the next year, for 2022, so this year, the IMF expects growth of around 5%. There are some problems with the table on the left-hand side, which I've taken from the last global outlook of the IMF, the International Monetary Fund. They produce 2 global outlooks a year. The last one is from October, and there you already realize the problem is from October. It was before Omicron was detected, so probably it's a bit too optimistic, which means that the economy probably didn't grow by 6% in 2021, and it also means that the economy probably won't grow by around 5% this year. The figures will be slightly lower. It won't change the relatively optimistic or positive story that I'm going to tell you. But you have to keep in mind that pandemic developments still impact on macroeconomic forecasts. When we look at the figures for 2021 and 22, we have to keep in mind that this is on top of an unprecedented contraction last year. In other words, it's quite easy to grow by 5% if you contracted by 8% in the previous year. In fact, in many countries, GDP at the moment is still below the pre-pandemic reading. In the UK, that's not the case anymore. The UK has actually now exceeded its pre-pandemic GDP value, but there are many countries around the globe where this isn't the case. As mentioned, the outlook is still encouraging, and that's despite many downside risks. Bill has talked about politics already. I've talked about COVID already, but there's also the problem with inflation as well as supply chain integrity. I've pressed the button. There's always delay. I'm trying to figure out when I have to press the button. Yeah, okay. So it takes around 5 seconds, I'd say. Let's talk about inflation. And inflation is a fairly new topic. It hasn't been impacting on businesses for, I'd say, a decade in most countries. Of course, there were always outliers. But at the moment, the situation is quite severe. The table here on the left-hand side is taken from JP Morgan. And they've shown you the inflation rates of the last 24 months in certain geographies. It might be a bit too small to read it properly. It's color-coded as well, so that just gives you a hint. If a country is blue, it means inflation is no big deal. If it's red, it means the warning lights are on. And as you can look on the right-hand side is the November value. You can see that inflation has gone up quite a lot over the last, I'd say, 9 months. In the US, it has now hit 7%. In Europe, Eurozone, UK, it's around 5%. There's still some outliers, Japan, Switzerland, where inflation is very low. But as a rule of thumb, it is an increasingly big problem. And why is that? Well, it's because it's a kind of a perfect storm at the moment. The base effect, so that means that will go away at some stage, but we're comparing against the price levels a year ago. A year ago, we were still in a lockdown. The economy wasn't doing that well, so that is distorting the comparison to some extent. But there are also demand and supply effects at play. From a demand perspective, the economy is doing well. I've shown you the GDP figures now, which means most countries are growing faster than their potential growth rate is. That always creates inflationary pressures, but there are still supply chain disruptions as well, and that is pushing prices up. And I will talk about the supply chain disruptions in a bit more detail later. There's still room to be optimistic for inflation rates to come down. They won't come down towards the 2% benchmark that most central banks have, but they won't stay on this 5%, 7% throughout this year. They will come down in the second half of the year, but they will still remain elevated in an historic comparison being the last decade or so. So we have base effects that will disappear, that will push inflation down. The supply chain disruption should become less pressing this year. And there's also the prospect of a more restrictive monetary policy. Where's inflation coming from? And this shows the figures for the UK. This is taken from ING, which is a bank. And you can also see one thing. I've told you that inflation will come down towards the second half of the year, but it also shows you that inflation will actually go up. So at the moment, it's around 5%. The colleagues at ING predicted to go up to around 6% in Q2. So it will get worse before it gets better. That's the messaging. And it's mainly driven by electricity as well as fuel, but other groups add to it as well. I can tell in Germany, there's a central bank uses around 100 commodities and goods to calculate inflation, and around 50 of these groups record increases bigger than 4% at the moment. So it's broad-based, but the main drivers are hydrocarbon products. I've told you there are reasons to be optimistic. I've already mentioned them. I just wanted to show you two other things. Why can we be a bit optimistic about inflation? One is the state of excess savings. If you remember, 2020, 2021, lockdowns, people couldn't spend the money they were still earning because they were working from home or because they were on furlough. And that led to a massive rise in excess savings. These are run down at the moment. So I'm not sure how many people you know, but I know a lot of people who bought a Peloton or who bought a hot tub or who bought a pizza oven. Of course, you can't generalize that, but demand was very high because people had a lot of money. They couldn't spend it on going to the restaurant. They couldn't spend it on their annual holiday. So they just bought goods, and that has increased demand, and that has increased price pressures. These excess savings have now been run down to some extent, and with the economic outlook a bit darker than it was a year ago, I'd also imagine that a lot of these savings are now held for some precautionary reasons. So you're not buying the hot tub this year, you're probably going to wait because your electricity bill is going up and you just want to have a bit of a buffer. So that should have some positive effects for inflation. The more important bit is the part on the right, which is a bit difficult to understand. I talk you through it. It talks about inflation expectations, and inflation expectations are very important. Why is that? Because it's a self-fulfilling prophecy. If consumers expect inflation to be high, it will be high, simply because you go into your wage negotiations with your boss, or you set sales prices in a completely different way if you expect 6% inflation compared with 2% inflation. The figure here on the right shows that inflation expectations are still anchored on fairly low levels, which means that companies as well as households expect central banks to do their job and keep inflation low. Again, there's a caveat. The figures here are from October, so slightly dated. If you want to look at inflation expectations going forward, I think it's a great idea, because as soon as companies and households expect much higher inflation, 4%, 5%, 6%, that's a red flag. That means that things could become nasty, because it could become a self-fulfilling prophecy. Let's have a look at the next topic, which was something I mentioned already, talking about monetary policy. Some of the inflationary pressures will be removed because central banks will take action. This shows a color-coded map from Bloomberg Economics. If a country is yellow, it means interest rates are likely to go up in that country. If it's blue, it means interest rate will go down. If it's gray, it means no change in interest rates. And you can see the US, Canada, Latin America, as well as the UK, interest rates will likely go up this year. That should remove some inflationary pressures. Russia, China will be the outliers. In the Eurozone, no change is expected in the interest rate, but that doesn't mean that the ECB won't take any action. It actually, they will take action. They will have other tools they can use to remove these inflationary pressures simply by abandoning or scaling down their asset purchasing program. When we move on to supply chains, we still see quite a lot of problems at the moment. At least there's an ongoing disruption, especially in maritime transport, which accounts for 90% of world trade. That has many reasons. Two of them are mentioned here. China is still adopting a zero COVID policy, which means they just lock down large areas. If there's a COVID outbreak, that has an impact on its port infrastructure. And because it has an impact on the Chinese port infrastructure, it has an impact on ports around the globe, especially on the US West Coast. The port of Los Angeles, Long Beach accounts for 40% of all the US goods imports. So it's a massive bottleneck. There are hundreds of ships moored in front of that port because they can't unload their cargo because there's simply too many ships for not enough space in the port. Lead times for semiconductors are also still up, 25 weeks at the moment compared with 15 weeks a few years ago. There's slightly good news when you look at prices for transportation. They're still going up, but they're not going up by as quickly as before. The improvements will depend on COVID. If COVID disappears, it will have massive, significant positive effects on supply chain disruption. So again, this is something where us economists depend on the virologists to make some forecasts. From what we can say at the moment is that supply chain risk is very elevated. The Federal Reserve Bank in the US, which is the central bank in the US, they have come up with a new metrics, which is the Global Supply Chain Pressure Index. That's the chart here on the bottom left. You can see it has reached an all-time high at the moment. So situation quite bad at the moment, but again, for the remainder of the year, things should improve. But again, COVID is the thing to watch here. Looking at the labor market quickly, there are signs of resilience. When we look at the top chart here on the left, we see a massive increase in the US, but that is mainly because of methodology, not so much caused by the actual developments. Just a bit of background here in the US, if you were on some government financed program because you effectively lost your job during COVID, you were counted as unemployed. In the UK, if you were on furlough, you weren't counted as unemployed. So despite the situation being very similar, it's simply an accounting difference that is at play here. So we had a massive increase in the US, but it has come down since then. Unemployment rates are pretty much back to where they were before the outbreak of the pandemic. And the good news here is the UK, because they have already ended their furlough scheme and unemployment didn't really go up at the end of that furlough scheme. So that certainly shows that the labor market is doing very well. In fact, the number of vacancies has risen a lot over the last year and a half. You can see that the bottom here, which is the number of job vacancies in the UK, they have reached an all-time high, close to 1.2 million vacant jobs. A lot of sectors actually struggling to fill these vacancies. What that leads to, I don't have to tell you, means that wages are rising. They're not rising by 5%, 6%, 7%, but they're rising quicker than they were before the pandemic. In real terms, wages are falling because inflation is so high, but the wage costs are certainly going up at the moment. I want to talk a bit about credit risk, but I'm running out of time, so I will skip these two slides. They show payments performance as well as business failures in certain countries. I know that the next presenter is covering credit risk in a bit more detail, so I'll leave that to Mark. The slides will be made available, so you can have a look at that in your own time. Before I sum up the key findings, I just want to quickly look at country risk because it is something that I worked in for more than a decade. Just a reminder what country risk is. Country risk is a combination of economic risks, GDP, unemployment, exchange rates, and so on. It looks at political risk. Bill has mentioned the rising risks in Ukraine or in the Pacific area. It looks at domestic changes. Italy is electing a new president at the moment that could lead to the government collapsing and some right-leaning administration coming into office and problems with the EU and so on and so on. So the political risk also plays a big part when you look at country risk. And then there are all sorts of commercial developments. For example, Transparency International has published its new Corruption Perceptions Index this morning, which is always a good read. So in a nutshell, that looks at country risk. The good news is that country risk has improved last year, and you can't see it because it's not a timeline. But I've color coded two maps here. One On the left-hand side is my previous employer down in Bradstreet. The right-hand side is Coface. It's pretty similar approach to country risk. You can see that the likes of US and parts of Western Europe, they are green, which means risk levels are low. Of course, you have the usual suspects in sub-Saharan Africa and the Middle East, where risk levels are still elevated. But overall, things have moved in the right direction last year, and that movement was more pronounced for countries that did a lot of the vaccination, because that limited the effect of COVID. But these countries were statistically or historically also the countries that had more fiscal firepower. They could simply throw the kitchen sink at the problem by launching furlough schemes, by handing out money to companies. So that helped as well. It was easier for France and Germany to support their economy than it was for Libya and Ethiopia, just in a comment. Last slide from my side, summary, key findings. I know I talked a lot about downside risks, but the underlying story is that the economy will grow this year from a global perspective. In fact, the advanced economies will do, not in absolute terms, they won't do better than the emerging markets in absolute terms, but that growth gap is fairly small. Normally, emerging economies grow much faster than the developed world. But this year, similar to last year, that gap is rather small. It has something to do with the trend that I already talked about 30 seconds ago. It's simply because of the amount of fiscal support that governments have unleashed. So 2022 will be a good year, maybe not as good as we thought 2 months ago, but the economies around the globe will grow. Inflation is a big issue at the moment. Will it be an issue throughout the year? Yes, it will. Will it get worse? Yes, it will. For the next few months. Will it get better then? I hope. I can't give you a guarantee, but as things stand, wage growth isn't in the area that we've seen in the 1970s when the wage price spiral was on. Inflation expectations haven't risen tremendously, so there's room to be optimistic that things get better in the second half of the year. Supply chain disruption will ease with countries coming out of lockdown. But again, if there's a new COVID variant next month that is more lethal and more infectious, none of these statements will be true. So keep watching that. I'm not a virologist. I can't make any forecasts about that. Credit risk, I haven't talked about because I skipped the slides, but it's the area where risk is probably going up. Despite the economy doing well, I expect that the interest rate rises that we see in many geographies will cause some problems for heavily indebted companies as well as households. The government support that we've seen is already scaled back in many countries. So all of that is causing some headwinds for companies, and that should make the job of a credit manager more interesting this year, despite the generally positive macroeconomic outlook. That's it from my side. As said, if you have any questions, if you have any comments, please send them over to us. Clara, hand back control over to you, or assign it to the next speaker, please.
Fantastic. Thank you very much, Marcus. As Marcus has said, the slides will be available after the event today on the AICDP website. If you have got any questions for Marcus, we will be having a panel discussion as soon as Mark Whiteley has spoken very, very shortly. So if you want to pop some of your questions into the chat, we will facilitate those. And what we're going to do is we're going to invite you to speak and ask the questions. So if you can pop them in the chat, it just makes it a little bit easier to make sure we cover you all. So thank you very much, Marcus. That was really, really insightful. I hope you all got a lot out of it. I'd like to move on now to introduce Simon Marshall, CEO of Copilot and a long-standing corporate partner of AICDP, who's going to be talking today about the challenges that Marcus has just mentioned, and I know Mark will also be talking about, that is facing credit risk management in 2022. So Simon, over to you. Simon, can you hear me?
You're still on mute, Simon.
Simon.
Right. So all those nice words saying hello didn't get anywhere, but hi everybody, good to see you. Okay, so hopefully, can you hear me now?
Yeah, we can hear you.
Okay, so hopefully my slide will come up. Okay, so I'm going to talk about the risk management challenges in 2022. We've heard Marcus talk about the fact that the outlook for the economy is good, but the outlook for credit risk is worse. Bill very presciently spoke about the way the world is changing and the geopolitical outlook, and we think that's a very important factor in risk. And all of that means uncertainty, and the geopolitical. I would talk about the breakdown of the liberal consensus, and the world that we live in the last 10 or so years has changed beyond all recognition, and things or safeties that we took for granted aren't there anymore. So I think there's a slight pause, isn't there? Yeah. So this is what we're going to talk about today. I'm going to flag up a couple of things. One is our essence of credit risk management events. And I'm going to talk about those because they will provide the framework for us as a community to discuss these topics. And I'm also going to talk about just briefly, about the 3 pillars of credit risk management, because they provide the model, or at least most of the model, for thinking about credit risk and how it's dealt with. And then I'm going to highlight some of the topics that we will discuss in the upcoming credit of risk events. No doubt you may have topics you want to add, and that's a good opportunity to either be posting some of that for the discussion forum at the end, and or encouraging some brief discussion of those topics. But for reasons I'll explain, most of these things we go into more depth with on the essence of credit risk events. So what are the essence of credit risk events? It's a co-pilot concept. They've been very well received. They're high level, and that means 2 things. It means it's high level for the participants. So we're looking for participants to either be the credit manager stroke credit director or the senior analyst. And it has to be at that level. You can't send somebody junior along because that devalues the process for everybody else. So it's very, very much high level, and that works to the benefit of the participants. Most of them are workshop style with 16 to 18 people in a room. And that works very well. And one of the reasons for not having had the events for a year or 2 is the obvious one, that we haven't been able to do that. So they're very confidential, and they operate under Chatham House rules, which means what's said in the room stays in the room. And that's important too, because it means that people feel free to speak and can express their opinions or share their knowledge more openly, and that helps to make them very effective. And we have an ambitious topic list, and I'm going to give you some examples later on, but you may want to add to them. And part of the format will be that, no doubt, and we're going to do this through, which we'll announce later, but we're probably going to do this through an executive club format. And that will provide the opportunity for people to flag up topics, perhaps in response to events that they want to discuss. There may be topics that a particular trade sector will want to discuss, all sorts of things like that. But we have some really strong topics lined up. So if we look at the 3 pillars of credit risk management, they are historic information, big data, and market intelligence. A lot of people say, or you hear people say, our financials dead, and I just don't agree with that at all. They remain very important, but they don't tell the whole picture, and we'll briefly come on to that. Non-financial information is very important, and so is analysis of it. And these are topics that we will be talking about. Big data, and that's a really big and powerful area now. That can be your own internal big data. Payment performance is a very good example, and being able to track that and factor it into decisioning in real time, for example, is very important. External big data is hugely powerful, and it's around what's happening out there, and what can we learn, and what do we know, and what things are affecting the companies we do business with. And that leads into market intelligence, because in part that's it. And top of that tree is focused credit team activity. And that's really important. And if I just give you a little case study, we had a client and they had a team of analysts looking after their global key accounts. One global key account failed, and the reason was fraudulent accounting irregularities. And as you know, that's normally something you find out near the end. But for this client, one of the red flags was late filing of accounts. And that told the analyst team, this is one I'd better go and have a closer look at. And even though it was accounting irregularities, 2 months before the event, there was a noise. And that made a big difference to the output for that client. So coming to the topics, it's slightly disconcerting because you press the button and then wait. Let's try, here we are, the topics. Okay, so one of the things we'll be talking about is information sources and managing them. Top of that list for most people is credit reference agencies. And before we come into just looking at that in a little more detail, just going to ask a question of everybody, which is like a little mini poll. And the question is, do you use the recommended credit limit provided in your credit reference agency reports? And the answer is either yes, I do, or no, I don't, but I still like to see the figure, or no, I don't look at that figure at all. I don't think it's important. I prefer to do my own analysis. If you'd like to just do your little vote on that. Wow, that is interesting, isn't it? Will we, I know we don't know who answered what afterwards, Claire, but will we have that statistic available?
Yes, we will, yes.
Yeah, that's really, really interesting. So 27% use it, 17 don't, and just over half, no, I don't use it, but I guess the figure is a guide, isn't it? It's an area we have views on, and a lot of our clients have views on, and it's one of the topics we would be discussing in the Essence of Risk workshops. We'll also, so we'll be talking about credit reference agencies. The credit reference agencies have done a good job during the pandemic, and most of them have developed models to help cope with COVID. They've developed COVID scores, that kind of thing. And when you work with companies in that area, there's a strong desire amongst them to improve the product and to help their clients and to respond to these situations. But also often other sources of information or analysis are important, especially perhaps in difficult parts of the world. And sometimes non-financial information can be as or more important than financial information, especially in areas of the world where you either can't get financials or you don't have confidence in the financials you do get. And part of what Copilot does is we have access to those sources of information. We have access to investigations. We call them the local heroes. And sometimes perhaps for your bigger risks, you want that higher level of information or analysis to guide you and support you in those decisions. And that's the kind of things that we talk about with our clients and help them with. And it's one of the things we'll be talking about in the Essence of Risk events. Within that topic, market intelligence is very important. What's happening out there, what's affecting our clients. what's affecting the markets. So some of that's economic analysis, some of it's geopolitical analysis, and some of it is market intelligence. And that can be trawling for market intelligence as a way of getting red flags, or it can be detailed investigation when you've got some intelligence and your analysts want to talk to that company. Can that poll disappear now, Claire?
I thought it had, sorry.
Not on mine, but yeah.
Is it gone?
No, not for me. I don't know about anybody else, but oh, I've got rid of it. Okay, we'll be talking about insolvency prediction models. We have a number of those available and they can be very important. We'll also be talking about scorecards. And we've just got another little question there, which is, can that come up, Claire?
Yeah.
Thank you. So these just a couple of little questions just to give us a little flavour in the room. But do you have your own scorecard? Yes or no? And if you do, does it include a credit limit setting model? And if you do, does it include non-financial information in the credit limits in that scorecard? Wow. That's 62% is well, it's changed now, 58, but that's a good number. And I think that shows the way the world is changing. And in 40%, it can set the credit limits, 60% it doesn't. Perhaps that's because you make a manual decision based upon what you've got. And I can't see the answer to number 3. Maybe I can scroll down. Yeah, oh, okay. A lot of you use non-financial information as well. All right, so apparently it's me that has to switch that off, Claire. So I'll do that. I think we've got to the end of that, haven't we? So that's gone. Okay, so we'll be talking about scorecards, and that's a big area for us, and it's a big area for our clients. We'll also be talking about credit limit setting models. And perhaps one of the topics that we're seeing huge interest in is red flags. And that's a really important thing. So you've got your scorecard, you've followed the scorecard, it's given you a score of whatever scoring regime you have, 326, A47, whatever it is, and that guides you to set a credit limit. But red flags are really very important. They can be financial. They could, for example, be some of the insolvency prediction models giving you a second opinion as to where you've got to. They could be events. They could be non-financial things. They could be market things. But to have red flags that just say, yeah, I've got my model. It said the credit limit is Y, but there's something happening over here that means I need to go and look further. It's giving me that red flag. It's important. We have a huge list of something we work on, red flags, and there are new ones being created all the time. And we will be running events on red flags. It's something we do day to day for our clients, but in the workshops, we'll be running events on red flags. It's important to keep that in balance. So client by client, the recommendations are very specific, but it's a really good topic to discuss. And that may lend itself to trade-based workshops where people are facing common issues. And another topic, and it's the last on this particular list, is efficiency and prioritization. So how important is that? What topics are important for the credit manager? Is it, for example, important to turn credit limits around quickly? How important is that? Sometimes it might appear to be outside your control. For example, if you've got credit insurance, you might be waiting for a credit limit to come back from the underwriter. Are there things you can do that speed up that process? Yes, there are. And how important is speed? How important is efficiency? How important is supporting sales in the overall scheme of things for you? i.e., for example, is there a desire to maximize available credit limits? And if so, what are the techniques you can use to help you achieve that? So all those are topics for the workshops. And I think that brings me, that was my last slide. Claire, shall I hand back to you?
You can. Thank you very much, Simon, and thank you very much for the information you've shared today. Again, all presentations from today will be available on the AICDP website after the event, along with a recording of this event today. As I said, we will be having a panel discussion after Mark's presentation. So if you would like to ask any questions, if you can just pop them in the chat for us. We will come to the questions very, very shortly. So now I'm delighted to welcome Mark Whiteley to speak to us next. Mark is trade credit and working capital solutions and specialist in mergers and acquisitions and private equity for Xenia. Mark, over to you.
Thank you, Claire. Good afternoon, everybody. This presentation, hopefully, following Bill, Marcus, and Simon's, hopefully will be about 10 minutes in duration. And yeah, I look forward to then going on to the panel discussions. First of all, thank you to AICDP for inviting Xenia to join the forum today. Shame it's not in person as planned, but I think we all understand the reasons for that. Am I sharing the screen? Am I on the screen now, Claire?
Yeah, so you should have access to control.
Okay. Yeah, got it. So yeah, in putting together today's presentation, which was obviously based on the reshaping of the future of credit in 2022, the subject matter, I'm sure we'll all agree it's probably the most unpredictable time in a generation as we've come out of the global pandemic. And I think we all probably still strive to return to those times in 2019 and the very early part of 2020. But I think, as Bill mentioned right at the very beginning of this seminar, that it's crucial that we all acknowledge that we are actually in a different environment, and some of the behaviour that we were used to and was, you know, second nature to us, we'll need to adapt to the circumstances. What I'm going to try and focus on today is to give you some insights, in particularly around insolvency, the information sharing, and the management of risk. We obviously do look at credit and political risk, but I think you've obviously had an insight today from Bill and Marcus regarding the political risks. So I'll focus more on the insolvency and the non-payment areas. The backdrop to entering this pandemic period was that the global credit insurance market had started to just see some creeping upwards of insolvency levels in 2017, which then started to mean reinsurers just looking at capacity, which obviously when the capacity is reduced, the pricing is impacted as well. A couple of big insolvencies in 2018, which meant that 2019, 2020, we started to see discussions with clients and underwriters, which was around an increase in risk. But as we entered the pandemic, you know, the GDP forecast reductions in 2020 and 2021 led to, you know, some very eye-watering predictions when it come to the insolvencies in 2020 and 2021. However, what actually happened globally was that there was a reduction in insolvencies in 2020, and then a further reduction, albeit by a smaller amount, in 2021. Why was that? And I'm sure we've all got our own thoughts on that. But one thing from the credit insurance community's perspective was that the government reinsurance scheme that came into play was very, very important for many economies, particularly around Europe. I think this is something that you probably are all aware, but maybe not all aware of the levels of support. So just to run down a quick table, France's budget for the support was 2 billion, Germany 30 billion, Netherlands 12 billion, the UK 10 billion, Italy 2 billion, Norway 2 billion, Belgium 900 million, Luxembourg 145 million, and Spain 500 million. So a real cross reference there of all the different governments and how seriously they took that or didn't take that, but that certainly did have an impact, as well as the other government measures to help business along during the pandemic. There we go. So in terms of looking towards the future, which is obviously the subject matter of today, I think it's important just to see the title of this graph, which is tracking the 2022 number versus the 2019 number, which, as I've just explained, is probably the baseline that we want to compare against. And yes, the credit risk, which is obviously what Marcus has also got some graphs on, is suggesting that the vast majority of the major economies will see increases in insolvencies. I'll come on to the three at the bottom there, but in terms of what is going to have an impact on that performance is, and I think we've all been here before in terms of considering the aspects that may mean that these numbers are lower or higher, for that matter, is what is factors like Omicron and many other new variants that may develop is going to have on business and on what governments decide to do. Have they got an ability to continue to support like they did before? There has been, as we've just explained, many businesses kept artificially alive, and that's not just through credit insurance or that support. It's around other support, and therefore, what we're also going to see is a return to business creation, and that's going to have an impact on business insolvency. So in terms of the 2022 global average, it is predicted to be a little bit lower than pre-COVID levels, but on the back of which it is starting to increase. So I think those factors that Marcus has pointed out, such as inflation, interest rates, etc., supply chains, is going to still drive that number higher. In terms of the countries that haven't had the government aid and the government's impacts, then we can see that they are going to have a more steep rise in insolvencies, just simply because there hasn't been support there. And also in terms of where there has been support, such as Spain and Italy, we will see that those economies are likely to have worse performance because of their dependency on tourism, etc. So those countries in particular will still need to be watched very closely. The three exceptions that I mentioned on the previous graph, South Korea, Brazil, Ireland, as the slides are likely to be shared after the event, you can obviously take up that in your own time. But there's reasons why that will be the case, rather than just assuming performance like other major economies. Just going to delay that. Yeah, Okay. So just looking at three major areas of the globe and what we're seeing from a survey that was conducted by one of our underwriters, Atradius. So in international payment habits, which is a quarterly production that is put together in North America and in Western Europe, you can see how credit is used in the US, Mexico, and Canada markets, and then the worsening payment performance there. I'm sure everybody will take out of these different stats relative to your own business and your own experience. But I think in terms of the signs there from the US is that, you know, it is taking longer to collect monies in. Historically, the US is a modest market for credit insurance, albeit it is growing quite significantly now. And therefore, those late payments that are being seen in the markets will feed through to slightly reduced appetite in terms of insurer capacity, but likely to show that the market will continue to grow with higher risk coming through. Again, without going through the individual statistics there, in terms of Western Europe, like I say, again, just take your own you know, benefit out of those statistics. But what we're likely to see is a worsening payment behavior throughout Europe. That again is probably going to mean that there's demand for credit insurance, and the supply from insurer capacity will be slightly impacted because of that. Something that we did pick up just recently, which some of you may be aware of, Belgium actually recently legislated to make 60 calendar days the maximum credit period that can be offered. So whether that's going to be seen in other European countries will remain to be seen. But it's quite an interesting interference from the government there about what credit period two commercial organizations can agree upon.
Bluetooth mode. Power off.
Hi, Claire. That yeah, there we go. Thank you. And then the other area that we wanted to focus on is China, and many of you probably have read a lot about this and seen on social media about what's happening within the China economy. And yet again, the bullets from the payment performance, but then the property, real estate, construction environment is going through huge stress at the moment. It appears to obviously be impacted by the Chinese government's three red lines, and this focuses on the largest and the eye-watering 300 billion owed by Evergrande to its creditors. But just last night I was reading an article that had other businesses, Yazoo, Dafa, Raisun, Shinsun, and Kaiser, who are all being impacted by these governmental decisions and guidance, with maybe not the same level of amount owed to creditors, but they are sizable, and these organisations are missing their interest payments, which obviously is upsetting the marketplace. Although interestingly, the stock market in China went up yesterday, in Hong Kong, sorry, went up yesterday, which was to do with some new instructions that have come through for government to ease the stresses on these businesses. So just looking to wrap that up as a conclusion, what is this likely to mean for our insurers? And some of you may use credit insurance already, so you may be already aware of this, and some who don't may be looking at insurance for the first time. But we have got a soft market as we sit here in terms of the flexibility that underwriters have. And that's really because of the claims activity that's been experienced because of those insolvencies. So therefore, in the short term, you're likely to be witnessing a greater risk acceptance. That is on the back of companies providing up-to-date financial information, which without that would be very, very difficult indeed for underwriters to support cover. But what we're expecting is that in that short term, the risk acceptance and the competitiveness from underwriters is certainly what we're witnessing at the moment. But it isn't normal behaviour, and therefore, as we look a little bit further down the line, then as we discussed, the global insolvencies, which look like they're going to be higher than what we're seeing in the credit crunch, if you believe the older predictions that are coming through, then that's going to impact on appetite and capacity, and therefore we do encourage you to work closely with your insurance company if you're currently insured, and look to develop longer term partnerships with them, and that will certainly stand you in good stead for risk appetite going forward, and being able to budget for your own sales and profitability. And that's everything from me. So thank you very much for listening. And any questions, please let me know.
Thank you very much, everybody. I'm now going to go over to questions. So if anybody has got any questions, I'm going to go through the chat. So Marcus, Simon and Mark, I'm going to ask you to also have a look at the chat and see what questions we have. So one of the questions I've got, hi everyone, credit control manager here from Waterwipes. Oh, sorry, that's just an introduction. I do apologise. Let's have a look. Claire, one question for Marcus after Bill's intro. In what are the thoughts on inflation in event of a limited Russia-Ukraine conflict blocking the existing gas pipeline? That probably leads to a wider discussion on Nord Stream, of course.
I'm trying to find the question. Is it in the chat function?
It is. It's in the question from Richard Tallboys.
Okay, let me find that one because it was a very long one.
Yeah, Marcus, it's Richard. Shall I verbalize it?
Yes, that would be great.
Yeah, it was just I was thinking about the pipeline that goes through Ukraine, because UK inflation has gone a bit potty recently, and a lot of it is to do with a dysfunctional gas market and shortage in gas price, the wholesale price, etc., which you well know. But there's been a lot of politics about Nord Stream not going ahead, about the reliance on the Ukraine pipeline. And gas is a significant contributor to inflation and power generation. So really, my question was, you're looking at inflation, short term going up then down again?
Yes.
How would you see it if pipeline gets blocked? Big question.
That's the baseline scenario, correct? That inflation will rise for a few more months and then starts dropping again. Again, not to 2%, but it will come down from the 6% it will probably see in spring. If we get a war in Ukraine, if we get some sanctions, if pipelines get blocked, if natural gas prices go up even further, then this scenario is probably too optimistic. Whether there is a war or not is to be seen. For the time being, it seems the most likely scenario that inflation will go up a bit further and then come down, but you're completely right. If the supply of gas will be cut off, storage units are quite low already, so that has contributed to the immense rise in hydrocarbon prices in Europe and other countries as well. That will become a more pressing issue. Yes.
Thank you very much, Marcus. Mark, I've got a question for you. So this business invests heavily in credit management and is this considered when pricing a policy?
Thank you, Claire. Yeah, that's a really good question. it's very, very important that when you're asking an insurance company to provide a quotation, that a very, very comprehensive submission is put together, and that should include details around the investment that goes into credit management, the resource involved, whether sales have an involvement, and to what levels that authority is provided. And certainly on the receipt of that information, we would absolutely expect the credit insurance underwriters to provide better terms for businesses that do invest heavily in credit management, not just on previous experience or previous losses, because obviously it's a forward-looking pricing rather than historic.
Thank you, Mark. We've got a question from Louise Nivard. I wonder if, Louise, you'd like to unmic and ask your question directly to the panel. I'm not sure if she can hear me. So Louise's question is, Mark has talked about recruitment being at an all-time high. Louise, is that you?
Yeah, sorry, I was pressing the wrong button.
That's okay. Louise, would you like to ask your question?
Yeah, thank you, Claire. Marcus, you talked about obviously recruitment being all-time high, and we're based in sort of East Anglia, so sort of out on that little bit that sticks out in the UK. And we are absolutely seeing that recruitment is quite challenging. So I was wondering if that is more localized, or whether kind of people are seeing that nationally and internationally as well, because what we're seeing is candidates are looking to transfer skills. So we're receiving applications from people who are not skilled necessarily in the credit area, but are looking to transfer their skills.
I'm not an expert on the East Anglian labour market. I have to admit. Nonetheless, I know that unemployment rates are varying across regions. So it's at least in Germany that there are stronger countries or lender than others, and in the south the labour market is more booming than in the north. And I would expect in the UK it's a very similar picture. What I can tell you is, when you look at the vacancies, the ONS publishes it by sector as well. So you can look at where actually the most vacancies at the moment, and unsurprisingly, the most vacancies at the moment are in accommodation and food. Nobody wants to work there at the moment. I think the vacancies per 100 employees are 7. So there are per 100 workers in accommodation and food, they have 7 vacancies. In other areas that stands at somewhere 2, 3. I think the national average is 4. At the moment, very bad for employers. The ratio of vacant position to unemployed people is very skewed towards the unemployed. So I think at the moment there are only 1.5 unemployed people per vacant job. Before the crisis, that was somewhere around 2.5, 3. So it's very difficult to find people at the moment, especially if you are recruiting for a very specialized role. I'm not sure if I answered your question. There is more detail about labor market situation on the ONS homepage. If any of you is interested in country risk, economic risk, political risk, and isn't connected with me on LinkedIn, please feel free to do so. I tend to post stuff there, maybe not about the East Anglia labor market, but the labor market in general, occasionally.
Simon or Mark, is there anything else you would like to add to that? No.
Claire, I think maybe Richard could give us a thought because of his own location on that question.
Richard?
Yeah, I got a bit of spare time on a Sunday afternoon. I live in the middle of East Anglia, but I don't work professionally, and I work out of London. But I got a bit of spare time, but it's weekend, couple of hours, I'm afraid. But yeah, I think every industry, you're right about hospitality and so forth. That's crazy. My daughter works in that, which is just a nonsense. But I haven't got any direct regional experience in credit management here. I'm sorry, I can't add much more to that. Thanks, Bill.
We have a question from Maylene Cosbert. Would you like to unmute and ask your question? I'm not sure whether she can hear me, so I'll ask the question. She asked, what does countries with low levels of vaccination mean to the global economies? So Marcus, would you like to start with that one?
Sorry, I couldn't find my arm to get to unmute. So thanks for asking the question.
Yeah, so I've shown you the list basically earlier in my presentation. You can see that the economic heavyweights, US, China, Japan, most of Europe, they all have very high vaccination rates. So the importance of Ethiopia, of Nigeria, probably isn't as big. So it's from that aspect, it's not necessarily a major concern. However, as we've seen over the past 2 years, everything is interconnected. Could be that your supplier sits in Mozambique or your supplier sits in Botswana. It's all interconnected. There are so many cogwheels. If there's some lockdown in some exotic country, it could easily impact on you. Or the other problem that we've seen, remember where Omicron came from? It basically was detected in South Africa. No one knows if it actually emerged in South Africa, but that's where it was first detected. The Delta variant came from India, if I remember correctly. So if there's a high share of unvaccinated people in a country, that means there's a bigger pool of people where the virus can spread. The more people that have the virus, the more likely it is that it mutates, and it could be that the mutation becomes quite dangerous. So it is important that the share of vaccinated people goes up from a supply chain perspective, as well of a COVID pandemic management perspective, because as long as it's still there, there's a latent risk to the economy, not only of that country where it is, but to all the other economies as well.
Thank you. Mark, we've got another question for you. So why would an insurer provide cover in an environment when more businesses are failing?
Okay. Good question again. I think really what that comes down to is the insurers very much want to be in longer term relationships with their clients. A lot easier to look in a longer window in terms of that relationship and those times that went well and those times that didn't go so well. So they acknowledge that in a hardening environment, they really want to try and support the clients for future relationships as well. I think the other aspect as well is that if they don't provide that support, then of course that can in itself mean a claimable event under their own policies. So it is a balance that an insurer does has to strike when they decide to or not to continue with the support. But overwhelmingly, when things are getting harder, that those longer term relationships are really, really important, and they'll want to reward that for their existing client book. But thank you for the question. It's a good one.
I endorse that from the same industry. Absolutely. Long-term continuity makes a huge difference. Jumping in now looks a bit speculative if you're not careful.
Thank you for that, Richard. Mike Diet, I've got a question from you in the chat. I wonder if you could unmic and ask your question for Simon on this one.
It's difficult for me to unmic given that I am Mike. Simon, having attended your previous Essence of Credit Risk events, again, I put it in the chat, but for those of you that haven't attended, I highly recommend it. They're very informative, very engaging. One of the best events I've attended, and I attend a lot of events. So if you haven't been, please attend the future ones, because you'll definitely get a lot out of it. Quick question, Simon, you mentioned red flags in your presentation. Given the fact that a lot of governments have shored up businesses through grants, loans, et cetera, and a lot of these businesses were able to shore up their balance sheets during the period. One of the things we've noticed is that the 2020 accounts, the financials, filed accounts, and the management accounts for 21 were not as bad as we would have predicted given the scope of the situation and the severity of the situation. So for us to be able to identify potential risks, we need to look beyond the financials. So can you give an example or some examples of some of the red flags that you guys at Copilot would recommend that credit professionals watch out for?
Simon, you're on mute.
Thanks, Mike, and thanks for that comment as well. That was nice. It's a huge list, and there are lots of things that are important. And probably top of the list as to what's important is what's your business doing? What type of customers is it trying to do business with? What are the risks or events that could be impacting those customers? And what information do you need that will help you have a better understanding of that risk or an early warning? So I mentioned before, for example, that there can be some finance-based red flags. One could be late filing of accounts, and that's a good one. It tells you something. Not every country has a late filing regime, so its effectiveness is different in different countries. And normally when we work that through with a client, we'll put in workarounds so that you're getting back to the same place. What can be very important, as I mentioned before, is insolvency prediction models, and the best ones are very, very good. And it can be very, very useful to have that running alongside your own scorecards so that you can get that red flag, and that's something that we advise clients on. I'm familiar with your business because a lot of your risk is the dealers, the Harley-Davidson dealers, and obviously non-financial information is likely to be a lot more important for you. And when we look at non-financials, again, it's always case by case, but we look for events or attributes that can correlate with business failure. And we normally typically categorize that under customer attributes, financial attributes, or priority attributes. And that obviously has to be tailor-made for each client. You'll be looking at, well, where's the information coming from that's helping us get that view? Is it market intelligence? Is it something else? Is it sometimes an investigation? Is it a better source of information and analysis? And all these things are available and can be factored in. We might also be looking at market intelligence. That could be specific intelligence related to the companies that you're doing business with. It could be market intelligence related to the markets that you're operating in. It could also include socioeconomic events. So there's just a whole list of things. We've got pages and pages of them. There are also some quite simple techniques that you can deploy that aren't particularly complicated, but they really add value to risk insight. So there's lots and lots of things that can be done.
Thank you very much. If anyone has got any final...
Mike, I wonder if I could just come in on that. If you're looking at a company that's been subjected to, that's had support from the government, either by way of grants or by way of furlough payments, etc., it's very, very useful when you're examining your accounts if you can drill down to the levels of support that they've had, because it will come into income. So if you can establish what's grants, what's furlough payments, and to what extent the furlough payments have been enhanced to their employees, it starts to give you a little bit of a picture of how they're performing. Once you factor in with that the reduction in revenue, it starts to get you a clearer picture of where they are.
It's an excellent point, Bill. And if you can get that information, or you know the characteristics you're looking for, which the red flags will help you with, then it helps you prepare for that call for your analyst to have that call to that client, doesn't it? And to know which questions to ask and to know what's important. If you remember when we did, I still, because I know people say, oh, financials are history, but if you remember at one of the workshops, we did a case study on Carillion, what that showed was that if you were looking at everybody said it was a surprise, but the case study showed that if you knew what you were looking for and you were looking at those financials, the warning signs were there. I don't know if you remember that one, Bill.
Yes, indeed, I do.
Perfect. Are there any more questions that anyone on the floor would like to ask the panel while we've got you today?
Claire, can I dive in again? Sorry, just stick to Mike's question. We've worked a lot during the last 2 years with the auto sector, looking through them to the dealership risk. So I'm totally in sympathy, Mike. Different kind of vehicle but not rather than two, but wheels. But looking at the dealership throughput, what they're actually selling, to cross-refer with what Bill just said, to actually correlate to actual income, but also looking now ahead at 2022 forecasts, and they're borrowing now for 22 without the government support. So that kind of number is not so much a red flag, but more part of what we're doing with our auto supply and financing clients. That's it.
Thank you very much, Richard. Thank you very much, everybody. I'm just going to take a few minutes. We've got a few people on the call today who are not already members of AICDP. So I literally just thought I would take 5 minutes just to talk you through what AICDP has to offer. I'm not going to take up too much time. If anyone would like any further information on joining AICDP, if they can just pop it in the chat, I will be in touch after the event today. So AICDP was formed in 2014, primarily to get credit directors and professionals together to share best practice and to share the DNA of credit professionals and to really boost the market in what they're operating in, not just in the UK, but globally, across the globe. Membership is growing. Since the back end of last year, we've had an influx of members approaching AICDP, all looking to get ahead in getting not just the education and the skills that they need to obviously do their roles, but also how they can network with their peers, how they can boost their connections across different industries, different sectors, but also get the help and support they need through the AICDP partnership. One of the things we have done in response to that is extend the AICDP website, which now has member offers. It now has a forum where you can ask questions and get your burning questions answered by one of our corporate partners or by another member in that sector. I think that for me, having worked with AICDP now for a number of years, is the support that is available through the community. We've had a lot of people on the call today from all different industries, sectors, different businesses of shape, sizes across the globe. Whenever anyone's got a question or they need help and support, there's always someone within AICDP who can offer that help and can get the answers to those questions quickly and effectively for you. So by being a member, we have access to a LinkedIn group where you can post those questions. We also have regular newsletters. And like I say, there is the facility on the website to post those questions that you've got. And membership is free. We host 3 to 4 events like this per year. We try and have events in the UK and Europe. It is our intention. We had hoped today that we would be meeting you face to face. Unfortunately, that hasn't happened, but we are planning our next event for March. And as I speak today, we are looking to try and to get that event to be a face-to-face event. We also have a membership group in Ireland. I think Declan's on the call today, and we have got a very active group over in Ireland. And we are looking at reinvigorating our groups in the Netherlands, Spain, and yeah, it's gone Germany, I think it is. So by being part of AICDP, you have access to all of these events. If they are online, we do record them, so you have access to them to watch back and refer to at a later date. If it is in person, we do try and make networking a real big part of the event, so that you can meet people, you can get the information you need, and build your own peer network as well around you to support your career. So as I've said, I think the 5 big key things for me for AICDP is the community, the training. So Bill has spoke very much about training today and helping get out of the bunker. AICDP is very, very passionate about giving credit professionals the training that they need, but not just in their role, but also in behavioural dynamics and other aspects of in other aspects of the training that they might need. It could be leadership and management, behavioural dynamics, team working, and bringing people back into the office as well will be a big part of the training for this year. Networking in events I've mentioned, and I've mentioned Declan Flood. We have got Declan on the call today, and we will be doing a future event on the education programme that AICDP offers, both for international and the wide range of courses available through that organisation. And we do have free webinars throughout the year as well on hot topics. And I can see certainly with what we've covered today, the geopolitical risk could be a very, very hot topic, and a webinar I'm sure will be following on very swiftly from this call. So that's just a very, very brief history and roundup of AICDP. I'd just like to say a thank you to all of our corporate partners and affiliate partners, which you can see on your screen right now, for their support and helping make AICDP the organisation that we are today. And I'd also like to take this opportunity to say a really, really big thank you to Marcus, to Mark, and to Simon for providing very insightful high-level presentations. I hope you've enjoyed it, and thank you very much for taking part. Bill, I'm going to hand over to you. Is there anything you would like to add in sort of closing statement?
No, thank you very much. Thank you everyone for attending. It was very insightful, as you said, Claire. It's good to have these things and have them on a regular basis. I very much look forward to the day that we can convert this to a face-to-face meeting, because clearly I'm very committed to that happening, and we are within the AICDP. So the sooner we can make that happen, the better. Thanks everyone very much.